Good morning, everyone, and welcome to this webinar on supply chain disruption and resilience from Zurich. My name is Alan Ross. I'm hosting today, and hopefully make sure everything runs smoothly for you. Before we get into the content of the webinar, just some housekeeping. As we run through the webinar, feel free to put any questions you have in the Q&A section as we go. If you're not familiar with Teams, there's a Q&A button on the menu on the sort of top of the screen towards the right-hand side. So if you click on that, there's a space where you can ask questions as you go. And you don't have to wait until the end of the webinar. You can put those in as we go through the session. We will also record the webinar. So just to let you know, we'll record it and we'll be uploading it to our YouTube channel in the coming days. And we'll also send you a link of that recording so that you can share the recording if you want to with any colleagues or anyone else you think is interested, or if it's so good you can watch it again. We'll also share a copy of the slides that we used during the session in that email, so you'll get those. If you've got any technical issues, then leaving and rejoining the webinar will solve most of those. Hopefully you won't, but yeah, as usual, it's kind of switch it off and switch it on again tends to solve most issues. In terms of supply chain disruption and resilience as a topic, we will all have noticed, I'm sure, disruption to supplies in the last few years, both in our personal and professional lives. Anyone that's tried to do any home improvements, buy a new car, repair a car, you'll know that the cost of materials has increased and lead times and supply times is increasing too. And your organisation in Zurich are dealing with these challenges too. And where we can't always kind of deal with the underlying issues that are causing those, there are things we can do to manage them. And this session really is about how do we get that supply chain resilience so that we keep that disruption to a minimum. So during the session, we'll discuss some of the reasons for why we're seeing the disruption that we're seeing. And we'll talk about how this affects us all in responding to claims, and also when you're dealing with vendors in your own organisations as well, and how you can manage some of those suppliers and hopefully become more resilient. We've got two subject matter experts to sort of lead the session today. The first is Nnamdi Ahuchugu. Nnamdi is a specialist risk engineer and he works within Zurich Resilience Solutions. And his role is working with our customers on supply chain risk and resilience projects and helping them manage their supply chain risks more effectively. And Nnamdi has over 20 years experience across a range of industries in supply chain and procurement roles. The second person you'll then hear from is Andrew Rawlings, and Andrew is our Head of Claims Vendor Management in Zurich in the UK. So he spends his time daily working with Zurich's vendors to understand, what the issues are and ensure that we are continue to meet our customers' needs when they have claims. So Andrew is well aware of many of the issues that they face, and also the work that we are doing to try and manage those issues. So without further ado, I'll hand over to Nnamdi, who's going to talk us through some of the kind of big risk factors that are causing some of this disruption.
Thank you very much, Alan, for that fantastic introduction. And I'd like to wish the audience a warm welcome to the webinar. Thank you for joining myself and my colleagues. Thank you for the opportunity to speak to you about supply chain disruption and resilience. So the contents for today's webinar will be in two parts. So I'll be taking the first part, where I'll be talking to the audience about understanding existing and emerging supply chain risks. I'll also talk about how we can use supply chain risk management to mitigate business interruption going forward. And then we'll also look at some of the attributes to look out for a resilient supply chain. Then I'll pass on to my colleague Andy, and Andy will go into some specifics around some of the supply chain challenges that he's seen from a claims perspective. And he will specifically look at motor claims, property claims, and then he'll also offer some advice on what can be done to manage some of those challenges. And then we'll go into a session of questions and answers. As Alan mentioned, please drop your questions in the chat. We'll pick them up at the end. And all I can say is enjoy the session. So moving into the first slide. So this is a montage of sort of a media events over the last 3 years. And one of the things I like to point out before I go into some of this detail is that supply chain and procurement issues and disruptions have always been there in the background. What has happened with the challenges that the world has seen over the last 3 years is that these supply chain disruptions, challenges, and concerns have been exacerbated by some of these issues and concerns, and it's been brought to the forefront of organizations effectively understanding that supply chains are important to the businesses, and if anything goes wrong with the supply chain, then it has a huge, massive impact on those organizations. And some of the events I will talk about. So the onset of Brexit. So Brexit was a huge supply chain disruption challenge. At the time, there were challenges with cross-border movement of goods and indeed services between the UK and the EU. So this brought with it lots of challenges for industry. And then we were hit with the unfortunate events of the pandemic, and that brought the entire nation, entire world to a standstill, thereby making everybody aware of the fact that supply chains were actually important, and when things stop and movement of goods and services stop, that the world in itself stops as well. And then we had the current ongoing geopolitical tensions and concerns between Russia and Ukraine, which again has had its own impact on organizations, supply of energy, supply of commodities such as crops, also precious metals as well, which is a key commodity that comes out of Ukraine. So yeah, so there's been a series of other events which have culminated in supply chain being a key focus for many organizations to try and build resilience around these supply chains, and to try and face the challenges that they bring into organizations, and try and put steps or contingency plans in place to stop these impacting their businesses adversely. Now, again, we've had issues and concerns in the past, and then we have a general view. And again, there are lots of risks and challenges and concerns out there from a supply chain perspective. But what we try to do with this section is just to try and highlight a few of those concerns that we think are key to supply chains going forward. So I'll just go through them really quickly on this slide. So inflation, financial strain, and I'll go through each and every one of these points in a little bit more detail in the next slide. But just to highlight, going forward, we think inflation and financial strain will be an issue. Climate change is going to play a big impact. Supply chain management in itself, and when I say supply chain management, I'm talking about the talent and the skills within the supply chain management function to be able to manage the disruptions within the supply chain. ESG, so environmental, social, and governance risks and concerns within supply chains. And finally, cybersecurity and ransomware. Like I said, this is not an exhaustive list, but these are some of the key ones that we thought we would highlight in this session, and go into a level of detail around some of the impacts it may have on organizations going forward. So let's look at the risk and impact of each one of these risks that we've highlighted. So inflation and financial concerns. So inflation, obviously we are in a time where the cost of everything is going up. As a result of this, we're seeing increased spend within organizations, and with increased spend comes a reduction in bottom line revenue, especially in cases where organizations can't necessarily pass that cost on to the consumers due to several different concerns around potential loss of business. But inflation is definitely putting a financial strain on lots of suppliers. One of the key things I like to talk to customers and clients about is about supplier financial health monitoring. So it's effectively keeping an eye on how the suppliers, your key critical suppliers within your organizations, are performing, and you can do this through various methods, such as a supplier relationship management process or business reviews with critical suppliers, and it's all about understanding how their business is performing, how they're dealing with the challenges of high inflation, how they're managing their costs, and how they are also maintaining that level of service that they're providing to you as an organization. So the unfortunate fact is that a lot of organizations are struggling and will continue to struggle through this inflationary period. We are starting to see some respite from an economic perspective on inflation, but I think the economy is we're not out of the woods in terms of the impact of inflation. And one of the major issues with inflation is that when the prices go up, they don't necessarily come down after we come out of that inflationary period. So this is something that organizations need to bear in mind going forward, and how they manage those challenges. Climate change. Climate change is likely to cause more extreme weather events going forward. And when I say weather events, I mean examples such as hurricanes, floods, droughts, and this can disrupt transportation channels and cause severe delays. One typical example is the movement of crop yields, which for some organizations is a direct raw material input into their processes, which means they can't manufacture the final process and final goods that they supply to their customers. And recently we saw the shortage of vegetables, tomatoes in particular in the supermarkets, and some of these challenges were caused by sort of climate change issues and the ability to transport the vegetables across the right transportation channels to get to the consumer. And a lot of organizations don't particularly understand their critical supply paths, their critical supply chains, and how climate change can impact or affect these critical transportation lines or supply chains. So it's a key recognition for organizations that they need to start to understand how these sort of events on climate, can impact their critical supply chains, thereby impacting their organizations as a whole. Supply chain management. So as I mentioned earlier, this is specifically looking at everything around supply chain management within an organization, from contract management to supply relationship management, how you deal with your suppliers, how you put contracts in place, how you execute those contracts with the suppliers. And again, it's about having the right talent and the right skills within the organization to be able to manage those contracts, put your robust risk management processes in place. And again, one thing that a lot of organizations take for granted is an understanding of who their critical suppliers are within their supply chain. It's amazing how many people through the years have had a bit of a mutation, a changing of the supply base, and then most of the time they understand the first tier of suppliers, but majority of the time they don't understand what's going on behind your supply chains. So the tier 2s, the tier 3s, the multi-tiers, where historically, a lot of the problems actually occur and cause disruption within the supply chain. Another typical example, if we look at the semiconductor industry, 80% of the world's supply of semiconductors comes from Taiwan. A lot of people aren't aware that a lot of the issues. So there was an issue of drought in Taiwan that effectively caused an issue with the manufacture of semiconductors, because water is an important constituent in the manufacture of semiconductor wafers and chips. And as a result of this had a knock-on effect to many other organizations. And a lot of the suppliers of those semiconductors weren't actually direct suppliers to the consumers or the users of the semiconductor chips. They were, in most cases, they were further down the supply chain of some of their end users or consumers. They were sort of in tier 3, tier 4 channels within the supply chain. And by the time it got the bullwhip effect of non-supply or disruption of the supply chain got to the first tier, it already caused a massive disruption to the industry. And there are still challenges with semiconductor supply, and various organizations are doing various different things to try and manage those associated risks. So very important that you have the right talents, the right people within your organizations, managing your supply chains and doing that strategic work that's required to understand what's going on in your multi-tier supply base. ESG concerns and risks. Again, there is a minefield, and I wouldn't be able to go through all of them in this session, but there is a minefield of different sort of legal and regulatory requirements that's coming and that will impact supply chains. One example that comes to mind is the Supply Chain Due Diligence Act in Germany, where there's a requirement for any organization that has a certain number of employees, of about 1,000 employees. They need to be able to show transparency within their supply chain. They need to be able to prove that there aren't incidents of child slavery or modern slavery within their supply chains, and they should be able to show this transparently and prove this in the event of an audit. And if that goes wrong, if they can't comply to this, then there's all sorts of fines, potential sanctions as a business as well. There's also the Conflict Minerals Act in Europe as a typical example again of legislation that's coming, and then the Modern Slavery Acts that are already in place that organizations need to comply to. And then when we look at greenhouse gas emissions as well, which is an environmental concern, Scope 3 emissions are your biggest form of greenhouse gas emissions, and Scope 3 emissions are sometimes also known as supply chain emissions. And these greenhouse gas emissions, a lot of companies and organizations are being challenged to be able to measure, monitor, and reduce their Scope 3 emissions and effectively greenhouse gas emissions and impact on the environment. And finally, cybersecurity and ransomware. So digitization of supply chain is an initiative that a lot of organizations are picking up on, and this is effectively to foster efficiency within the supply chain. A lot of processes you find in procurement supply chain are very manual in nature. They're very spreadsheet based. So a lot of organizations are starting to invest in automation, automated systems, digitization of these systems to sort of breed that efficiency and work more effectively within the supply chain function. But as a result of this, with the digitalization, with it brings the risks of cybersecurity and ransomware. As your supply chain becomes more complex, and the environment is prone to a lot more cyber threats and cyber attacks. So it's not to scare people or to stop people from going along the digitalization journey, digitalization map, but it's about understanding this risk and understanding how you mitigate and you manage those risks as you move on within the supply chains. And then I'll just put up some statistics there from the Business Continuity Institute's Supply Chain Resilience Report for 2023. It just talks about some of the main causes of disruption in the last 12 months. So featuring very highly there is a loss of talent skills. So a lot of people have moved around organizations, and I think Andy will talk about specifics in his part of the presentation. Illness as a result of the pandemic and other illnesses as well, transportation network disruption, adverse weather, and again cyber attack, as I mentioned. And then the main concerns in terms of supply chain resiliency over the next 5 years, as organizations start to build resiliency, what are the challenges they think they will have within the organization? So cyber again features quite heavily. Adverse weather and natural disasters from a climate change perspective, the energy concerns and energy scarcity, and then again new laws and compliance that we touched on fairly briefly. Okay, moving on to the next slide. So we understand what the risks are currently, we understand what the risks are moving forward. How can organizations start to look at how they manage these risks going forward? Now, a big part of my time in industry within supply chain was all about collaboration. So a lot of people think that supply chains is purely down to the procurement and the supply chain, warehousing and logistics functions, but actually supply chain management is everybody that has a hand or an input into fulfilling a customer need. So the customer has a need, and there's various departments and various different functions that have to collaborate and work together to effectively fulfill that customer need. So for me, it's every function that has that hand in that fulfillment process is part of the supply chain. Yes, the suppliers are managed and looked after by your procurement teams and your supply chain teams, but everybody within the organization has a part to play and is a stakeholder within the supply chain management function. And without collaboration, it will not work. And I like to liken, and I've told this story several times in some of the other sessions that I've done, I like to liken the supply chain to a relay race where everybody runs a leg of the race. And when you think about a relay race, it's not about who runs the fastest leg that wins that relay race, but it's about who does the best handover from one runner to another that actually wins the race. And that's what supply chains are like. So everybody in a department does their bit of the supply chain, but they have to have a seamless handover from their process to the next person within the supply chain. They perform their processes efficiently, and then they pass that on to the next department, and that carries on till the customer need is fulfilled. But when that is all happening through the process, there is a flow of information that's consistently going on between departments and between functions, and that has to be seamless, and that has to work well for supply chains to actually be free of disruption, or to be able to minimize or mitigate any disruption. Once something goes wrong with that flow of information or that flow of demand within the supply chain, then that's where you start to get disruptions within the organizations. So organizations that perform very well, that perform excellently from a supply chain risk management perspective, you'll find that they probably have a good cadence of interdepartmental interaction and meetings and collaborations within the organizations that ensures that they mitigate any form of risk that they may have. How can Zurich help? We follow a very robust risk management process from a Zurich perspective, and we're of the ethos that prevention, where possible, is better than cure. So rather than firefighting when the event has happened, if there's ways and means of mitigating or putting a plan in place in the event of a problem happening, then it gives the organization a little bit more resilience. So typically, from a Zurich perspective, if we were to work with a client or were to work with an organization, this is the approach that we would take, very much a risk-based approach. So we will start with a supply chain assessment, where we look at all sorts of different facets of your supply chains, from identifying critical suppliers, identifying your vulnerabilities, doing all forms of loss scenario mapping, so you can understand where your vulnerabilities and your pinch points are as a business. Quantify that risk exposure, and then develop your mitigation plans. And then ultimately, you have the data as an organization, you have that detail, you have that understanding to be able to make an informed decision. And then ultimately, businesses are in place to make money, they're in place for profitability reasons. So ultimately, the whole ethos around the risk-based approach is to ensure that operational profitability is supported from a business perspective. And then finally, from myself, last slide from me. So we've understood the risks. We look at ways to collaborate within the organization, and then we follow a risk-based approach to sort of manage and mitigate those risks. What are the attributes that you start to look out for a resilient supply chain? So what are those points or things that you need to, factors that you need to see to understand that your supply chain is starting to have a level of resiliency? So again, I talked about collaboration in the previous slides, so very, very key. Visibility, end to end. So understanding your supply chains and monitoring your supply chains in real time, and effectively on a consistent basis, speaking to your suppliers, your critical suppliers, and understanding how you can work closely with these suppliers to help them manage the risks and the challenges that they may have in their organizations. And one of the key things in supply chain risk management is data. So data can be used to tell a story. It can be used to provide insights into your business and to understand how your business is performing or where you can do better from an efficiency perspective. Have a risk management process in place. Very, very key that there is a risk management process in place, because if you don't have those processes in place, then you're prone and liable to continued disruption and continued impact on your bottom line as a business. Continuous improvement. So continually test your processes, test your business continuity plans, and understand how you can improve them and how you can make them better. Because a process, the thing with supply chains are quite dynamic. What would have worked today within the organization may become defunct or not relevant tomorrow. So that's why we push the factor of continuous improvements, continually looking at your processes, evaluating your processes, and seeing how you can make them better going forward. Crisis management, a key one, because as much as we try, unfortunately, not all the risks can be stopped or prevented. Some risks will still break through within organizations, and it's important that we have a crisis management process in place in the event of one of those risks or some of those risks coming through and starting to impact the organization. It's about understanding, having a plan and a structure of how you tackle and approach those risks. Very, very important that you maintain strong partnerships with your supply base as well. Understand who your critical suppliers are. Understand who the suppliers are that can hurt your businesses quite significantly if there's a disruption of supply from their perspective, and work with them, build strong partnerships, have a supplier relationship management process in place, at least for these key suppliers. And with all these attributes, we firmly believe that organizations can build a high level of resilience from a supply chain perspective. So I will now pass on to my colleague Andy, and Andy will go into some specifics from a claims perspective.
Hello everybody, thank you Nnamdi for that. As you can probably imagine, many of the global and macroeconomic factors that Namdi has just taken us through clearly impact on the insurance supply chain just as much as any other supply chain. And before I get into some of the specifics with regard to motor claims and property claims and so on, I thought it'd be worthwhile just taking some time to refresh some of what the impact that some of those aspects of the last 3 years that we've all experienced, what the impact they've had on the insurance supply chain. Now, you may be sitting there thinking that much time has elapsed since Brexit and COVID was 2 or 3 years ago and things like that. And you may be thinking, well, are those situations still something that can be blamed for rising insurance costs and delays to claims and things like that? The short answer is unfortunately yes. COVID, Brexit, and indeed the ongoing conflict in Ukraine have all had their specific impacts. And when you combine them all, you could argue that the UK insurance market has experienced a bit of a perfect storm of economic impacts that have applied across the board. And the fallout from those impacts continues to be felt today. Indeed, the conflict in Ukraine is obviously ongoing, and that's led to continuance of sanctions affecting Russia and Ukraine. Taking some of the specifics, in terms of COVID, the initial COVID lockdowns that the world experienced in the second quarter of 2020 led to significant factory closures around the world, and indeed, many workers were put on furlough or even laid off over the globe. Then when those lockdowns started to be lifted and markets started to open up again, even though in some cases that was only after about 2 or 3 months of the lockdowns being experienced, a significant imbalance in the global supply and demand was created. Whereas at the end of 2019, many markets around the world were pretty much in balance. Suddenly, global manufacturing capacity was pretty much challenged, creating shortages of most building materials, motor spare parts, and as Namdi has mentioned, microchips. Within the UK, worker furloughs initiated by the COVID lockdowns, combined with the effects of Brexit, led to many workers leaving industries such as the building industry and motor repair industry and the hospitality industry in the UK. Some issues are also being seen to a certain extent in the private healthcare industry. In 2019, about 25% of the labour force in the motor and property repair sectors were said to be EU nationals. And unfortunately, Brexit and the COVID furlough situation led to many of those workers returning to their home countries. And unfortunately, they have yet to return back to the UK. Even though it could be argued that the impacts of COVID are fortunately receding, and I'm sure that's being welcomed by all of us, current UK immigration policy doesn't necessarily make it easy or attractive for those non-UK nationals who did return home a couple of years ago to return to work here. In addition, many of the UK nationals in the motor and property repair industries were part of an ageing workforce. Many workers in their 50s chose to retire early or pursue other careers, and many have not returned to work to the industry that they worked in pre the COVID pandemic. Indeed, the UK is said to be experiencing high non-employment, which is a bit different to high unemployment. This is to do with workers who are not currently in work, but also not seeking work. And this resulted in a quite a tight labour market across the board. Many workers who were furloughed during the COVID lockdowns have also left the original industries and chosen to pursue other opportunities. For example, many HGV drivers chose to take advantage of the booming retail home delivery market, as their work-life balance in that sector is so much better than long-distance lorry driving. In terms of the logistics industry, the COVID lockdowns also created many challenges in terms of the global logistics industry. Many products previously were sourced overseas, and those challenges obviously created issues in obtaining products as and when the markets reopened. Fortunately, that situation is steadily improving. And finally, with regard to COVID, until recently, China tried to pursue a zero COVID policy, which continued to lead to lockdowns and restrictions in many parts of the country. That's led to a continued impact on products sourced via China. Fortunately, China seemed to relax this policy earlier this year, which will hopefully lead to improved product availability. But on the other hand, increased demand from China could lead to more inflationary pressure, especially in terms of raw materials. In terms of Brexit, sorry, Namdi, can you just go back to the previous slide, please? In terms of Brexit, the main impact from Brexit is probably related to the UK labour market and the shortage of skilled labourers in the motor and property repair industries. It's possible that increases in trade barriers with the EU following Brexit may be a factor in current inflation, but it's difficult to pinpoint the exact impact of this on prices. And finally, in this section, the main impact from the conflict in Ukraine is the imposition of sanctions on products sourced from Ukraine, Russia, and Belarus. Increased energy prices are probably the most inflationary aspect here. And whilst global energy prices are said to be reducing, mainly due to the lower than expected demand in the winter of 2022-2023, the effects of these higher energy prices are still being experienced today. Also, products such as birch plywood remain in short supply. Most of birch plywood originates from Russia, although there are some limited supplies available from places like Latvia and Finland. And as Nandi said, other natural resources, which are typically sourced from Ukraine and Russia, such as neon, copper, aluminium, nickel, platinum, etc., remain in short supply, leading to inflation. And the Ukraine is actually quite a large and significant producer of vehicle wiring looms. So moving on to motor and some of the specifics that have affected the motor repair market. I've obviously spoken about the impact of COVID on the tight labour market, and because of that, there is a distinct shortage of skilled labour in the motor repair industry, which has caused a significant bottleneck and capacity challenge there. We also have some competing industries, other industries around the country which use skilled metal, fiberglass, and paint technicians are actually attracting much of the labour away from the motor repair industry, and this can actually be regional in some cases. The boating industry in many coastal towns has attracted many motor repair technicians to go and work in that particular industry. Overall, the tight labour market has led to salary inflation, as you can probably imagine, and in the last year, between 21 and 22, the market has probably experienced approximately a 15% increase in labour costs. And due to the lack of labour within the motor repair industry, actually space for the storage of damaged vehicles is also becoming a bit of a premium commodity around the industry. And there are anecdotes of fields and car parks actually full to the gunnels with cars awaiting repair. In terms of motor spare parts, over the last couple of years, we've seen inflation in parts costs, but there may be some green shoots of recovery there, and we may be seeing some signs that vehicle spare part availability may be starting to improve. There are still some problematic areas and some hotspots. Manufacturers experiencing the most difficulties seem to be Mercedes, Renault, Citroën and Vauxhall. And in some cases, with regards to Mercedes radar units, the lead time for availability is said to be quoted as being 2024. Nothing more specific than that, just next year. In terms of inflation for car parts, last year was probably somewhere in the region of just under 10%. But hopefully, as a result of the improving availability, inflation with regard to car parts could now be lower. Commercial vehicle parts, for those of you who are interested in that area, for 2022 was reported to be around 13%. Slight exception to those figures is paint. The market saw price increases for paint of about 16% in 2022 and a further 8% increase from the paint manufacturers as it was announced in February of this year. The global shortage of microchips that Nnamdi mentioned experienced over the last 3 years or so has significantly affected the amount of new vehicles produced around the world. This lack of availability of new cars has led to significant inflation in used car prices over the last 2 years, as anyone who has probably been in the market for a new car or even a used car has probably experienced. According to Auto Trader, used car inflation in March 22 reached about 32%, which has clearly significantly impacted on total loss valuations in our world. On a more positive note, though, improving availability of new cars has resulted in used car inflation falling, and in March of this year, it was said to be around about the 2% market, the 2% factor, sorry. This situation has also greatly affected the ability for motor repairers and car rental companies to provide courtesy cars for customer use while their vehicle was being repaired. And although new vehicle availability is improving, shortage of courtesy cars at motor repairers remain to this day. Indeed, probably due to the lack of low-cost finance, due to higher interest rates to try and combat inflation, and the lack of discounts from vehicle manufacturers, many motor repairers are now choosing to be financially prudent when investing in courtesy car fleets and are actually limiting the size to avoid financially overstretching themselves. The motor repair industry is actually quite an energy intensive one, and the global energy situation has led to a significant inflationary impact with regard to motor repairs. Prior to COVID, the cost of energy per on-site motor repair was said to be about £20 per repair. Today, in Q1 2023, that has increased to about £75 per repair. Potential impacts, future impacts here, are very much likely to depend on future global energy prices, and obviously everyone waits with bated breath to see what happens over the course of the summer and next winter. Overall, obviously all of these impacts have led to increased repair costs, and over the course of 2022, motor repairs have probably increased in value by about 10 to 15%. This has also the challenges in terms of capacity have also led to increased delays in repairs, to both in terms of booking in times for vehicles and also the repair times that vehicles take when they're actually booked into garages. Pre-COVID, the average repair booking in time was probably around 2 weeks, with a repair cycle time of around another 2 weeks to actually get the car repaired. Today, average repair booking in times are probably more like 6 weeks, with repair cycle times more like 3 weeks in terms of actually waiting for that car to be finished off. As you can imagine, this has led to increased customer dissatisfaction with regard to what's going on and complaints, especially around personal lines claims. And the final thing to mention, this doesn't just affect first party claims or accidental damage claims, it can also affect third party claims and credit hire aspects. Moving on to property, specifically property, the situation in property is very similar to the motor repair market, and there is a distinct shortage of skilled labour in the property repair industry as well, such as plumbers, joiners, painters and bricklayers, creating another significant capacity challenge in that particular market. Overall, salary inflation was probably around the 5 to 6% mark in 2022 and is forecast to increase by a further 6% this year. We also have more competing industries in the property repair market. During the COVID lockdowns, a boom in home improvement markets was created, which exacerbated the supply and demand imbalance in this particular industry, and also things like the home building industry and capital infrastructure projects such as HS2 and the Hinkley nuclear power plant also attracted more of the limited capacity in the construction sector. Non-insurance related construction projects have become very lucrative for the building industry, and many building and contractors have switched away from insurance related jobs into private jobs, and order books at many small building firms currently remain very healthy. However, it'd be interesting to see what impact the downturn in the overall UK economy has on this particular market. Will we see more building firms wishing to return to the insurance sector or not, as the case may be? The construction sector also typically does suffer from business failure, unfortunately. And with regard to the economic downturn, it'll be interesting to see if that actually leads to more building and contractor insolvencies, which will obviously clearly reduce competition and capacity further. Unfortunately, weather events typically over the winter tend to lead to further capacity challenges in terms of the building repair industry, and that was certainly seen to be the case last year with a bit of a subsidence surge, and over last winter where we had a bit of a freeze. In terms of building materials, average inflation for building materials was about 15 to 20% last year, but some examples which are higher than that can be UPVC windows, which are said to be about 45%, roofing materials about 28%, and anything involving clay, such as bricks and tiles and so on, about 26%. Availability of building materials is generally starting to improve, and some materials prices are easing, especially in terms of timber, except for birch plywood, which obviously comes from Russia. In 2023, we may actually see quite low building material inflation because of price reductions in some areas, before returning to approximately about 2% in next year. But those materials which are very high in terms of energy input, such as bricks, plaster, tiles and glass, will probably still see prices rising. In terms of overall prices, the Building Cost Information Service estimated that general building cost inflation was said to be about 13% last year, but the inflationary picture is looking a little better for this year. Some commentators are forecasting building cost inflation for this year about 5 to 6%, but others believe it will be more like between 2.5% and 3%. Thereafter, between 2024 and 2027, building cost inflation is expected to be around 2.5% per year. But as you can probably imagine, there is a high degree of uncertainty in relation to those particular estimates. And the uncertainty as to what the future holds in terms of what's going to happen in the markets has made it very difficult to plan and reserve for claims, especially those with a longer cycle time. And this has led to higher alternative accommodation costs as well as higher building repair costs. And again, similar to motor, it's led to increased customer dissatisfaction and complaints, again, especially in the personal lines markets. In overall summary, the main issues that will continue to affect our market are likely to be the labour market and the energy market. Both are long-term global issues which are likely to have an impact on our market for the foreseeable future. And whilst the motor and construction industries are said to be increasing the amount of apprenticeships on offer, these new apprentices will take some time to develop their skills and expertise and become qualified practitioners. Indeed, Capital Economics have estimated that the UK's labour market issues are likely to persist until at least late 2024. So with all of that, what can be done around in terms of trying to deal with some of these issues? Well, as Nnamdi has said, we're trying to keep customers and colleagues informed of the challenging market situation as much as we possibly can, working closely with our claims supply chain to assist in managing the situation. Cash flow is an important part of many of our insurance suppliers. We're working with them in terms of paying them quicker, approving repairs and motor repairs quicker, giving fair consideration to price increase requests, and sharing information for the mutual benefit of all. And that is very important when it comes to identifying where some pinch points and some hotspots may well be arising. We've been looking into whether we can repair damaged items rather than replace them a bit more, and there have been some very creative repairing of items, specifically things like headlamp units. In the past, headlamp units were typically just thrown away and replaced with new ones, but there are anecdotes out there now of motor repairers actually undertaking welding of plastic and repairing headlamp units whilst they're waiting for new ones to arrive. We've had to prioritise undrivable vehicles for repair over drivable vehicles. That's not necessarily popular in some aspects, but it has been necessary because of the restrictions in capacity in the market. And where appropriate, we have encouraged the increased utilisation of green parts on motor repairs. Green parts typically are second-hand parts from other damaged vehicles. And we've also tried to look into more cash settlements in terms of property repairs rather than relying on the supply chain, again, where appropriate. And in terms of courtesy car use, to be honest, if customers and drivers can get away without having a courtesy car with repair, that might actually help in terms of getting their cars booked in for repair. And one of the things that we've been trying to do is offer alternatives to courtesy cars via our courtesy care offering. These may not be particularly helpful in terms of mobility, but into what we're trying to offer is things like can we offer vouchers for Halfords to get out and about on bikes in terms of utilising a car, or where other options for courtesy cars may be available at the customers. We are willing to make other contributions to the environment, whereby we're planting more trees or making a donation to charity instead of providing a courtesy car for customers. So that's a bit of a whistle-stop tour as to how the supply chain challenges have impacted on the insurance supply chain and claims arena. And I think we're now going back over to questions and answers.
Yeah, thank you. Thanks. So that's really interesting, albeit it's quite quite a challenging picture, isn't it? The whole supply chain environment. So please, we have got some time for questions and answers. So please put your questions in the Q&A function. Ruth Kidd has put a question in. Thanks, Ruth. So I think this is probably directed more at you, Andy, but the question is, where there are increased complaints, how will this impact on retention? And how can customers with fleets improve the credit hire picture? I'm seeing higher costs for credit hire as repairs are taking longer, which then impacts on our claims experience and ultimately premiums. So yeah, how can customers with fleets improve the credit hire picture?
I think the two aspects there. Retention, in terms of that, everybody is experiencing the same situations with regard to the markets. Clearly, individual customers may well choose to shop around and understand what is available elsewhere with other insurance carriers and so on and so forth. We are doing our very best to maintain customer service with regard to both motor and property. It's certainly been a challenge over the last 3 years. I cannot deny that. But we're, as I've said in my last slide, we are working very closely with our supply chains to minimise the impact of customer dissatisfaction as much as we possibly can, with the idea of obviously improving customer retention as much as we possibly can. This isn't just a Zurich issue, as I've said. Everybody is experiencing it. In terms of the credit hire picture, I'm not a claims expert in terms of how the operational picture works, but what I would say is time is of the essence. So if there is a third party issue where one of your drivers or one of your customers has unfortunately hit a third party, we need to be able to understand what's happened there as quickly as possible so that we can try and deal with the issue as quickly as possible. The longer specifically a third party claim takes to get into that particular, to be rectified or what have you, we'll see more cost being incurred. There's a general rule of thumb that the longer a claim takes, the more it costs. And so I would say, yeah, definitely encourage early reporting of instances so that the claims teams can intervene as much as possible and get that early intervention underway as quickly as possible.
Thanks, Andy. And yeah, Kevin has asked, can we have a copy of the recording and slides? Yeah, they will be sent to you, Kevin, in the coming days. Just until, I mean, commonly when we have conversations with customers around this, we also get questions around, a lot of insurers seem to use the same repair networks. Have we looked at other providers, maybe smaller providers, but that might have more availability? I don't know if that's something we've looked at, Andy, or are they also experiencing these same problems?
It's a bit of a balancing act. From what we understand from the entire motor repair industry, and indeed the National Body Repair Association, who are the industry body that look after all of motor repairers, have basically come out over the last few years and basically said everybody in the motor repair industry is really, really busy, whether they be an individual body shop or part of a group. We work with 3 main networks, and we overall have access to just under 1,000 body shops across the UK. Clearly, part of our interest is maintaining UK coverage for our customer base. And when I refer to the balancing act, it's all about how can we ensure that we get access to the supply chain that we require whilst being cost efficient and cost effective, and also being able to meet our all of the various requirements that we have from a due diligence, understanding the provenance of those repairers, and obviously meeting our other regulatory aspects. So I'm not sure that at the moment that other repairers generally have more capacity, but again, we do our best to seek that out. And when we're working with more centralized networks, it actually is easier to understand where there may well be capacity in certain areas. That is, the motor repair industry is very, very fragmented. We work with the largest independent body shop network, which is FMG, who have about 75 sites around the country. I think the next largest is the Steer Group, who have 57. But there are thousands of body shops around the country, and it actually helps by having a centralized operations so that we can actually seek out capacity where it might be available.
Okay, thank you. And just a final thought then, how long is this going to last? Is this the new normal? Do we need to get used to it? Is are things going to go back to how they were before COVID, or is this, do we see the disruption lasting, far into the future? Andy, I'll ask you first.
Yeah, I think it's a very difficult one, Alan, to answer, because like I said in my initial when I initially started the presentation, I think supply chain issues and disruptions have always been there. It's always been the responsibility of procurement and supply chain professionals to sort of manage disruptions. The events that have happened over the last 3 years have, increased the magnitude of the impact of these issues. It's all about how you manage and you put plans in place to mitigate those issues. Every business is different. Every business will have a different level of impact, but you need to understand what works for your business and what works for your supply base and the suppliers that you work with. So I think it's a challenge for supply chain professionals, procurement professionals, or if you want to work with third-party sort of risk management organizations that can help organizations understand that. So you need to understand your supply chain. You need to know what's going on in your supply chain, and you need to make it a habit to consistently talk to your suppliers and monitor what's going on with them, especially if they're critical to your business. So I think this is an ongoing affair. The magnitude of it will differ as time goes on.
Thank you, and just we're almost at time, so I'll bring it to a close. I just want to thank everyone for attending. As I say, you will get a copy of the slides emailed to you, and also a link to the recording. Should you want to watch it again, or as I say, please feel free to share it with any colleagues that you think might benefit from it. And also please feel free to contact Namdi or Andy. Their contact details are there, or indeed speak to your usual Zurich representative. So other than that, just like to thank you, and enjoy the rest of your Tuesday.